Hi, welcome for all of you guys who are here with us today. Thank you for coming to join us. And we know that this is almost coming towards the end of the seminar series for the Quantitative Investing Festival. And also at the same time, we are concurrently running the IGM SUSS Joint Case Study Challenge. So we've asked all of us over here today in the webinar, we have a mix of our private investors. We have a mix of some of my very close friends who are managing funds. And I know some of you guys over here, the majority would be actually students from SUSS who are actually here as part of the case study challenge. I think the contents is something that will be interesting across for not only the very sophisticated investors, the retail investors, for students alike. I'm sure all this will be things that will interest you. And of course, as we mentioned, you coming back over the last one or two sessions in all of this seminar series. And of course, with us today, we have the SUSS partners, and also all this knowledge that you have, all this information that we have are all put together by our educational partners, all Quants. So this is almost the second last sessions in the Quantitative Investing Festival. And I know for the students around, those who are here for the Investment Advisory Case Challenge, many of you guys will be finding all this information available across in our IGM applications. And even for some of you guys who are already investing with us, or maybe you might be stepping on the journey to invest with us, you will know that all this information are also available on our phone applications. And for those of the students who are around, I think today you have received a message across from Joel, our manager who's actually managing this whole festival, and he will have shared across with you guys a URL to go on to register for your coaching sessions before the case challenge that we are going to have in the next few weeks. So click on over to the link over there, and you will be able to book your 1 hour coaching session across with some of us, and we will come back over to you to share with you how better to run your case challenge. Of course, for those of you guys who are here as part of the quantitative investments, we don't have the coaching session across over with you, but of course, we are very happy to catch up with you if required. And as what we mentioned, this whole festival, this whole event that we have is really put together across with our wonderful partners from SUSS. And since now we're coming off onto the fourth session and the closing sessions for the whole case study challenge, I really want to invite our student presenter, Angeline. Angeline is coming online to share with us some words as part of the closing for this whole investment case challenge. Angeline, I think you are over there. If you can just unmute yourself, and I think we want to hear something across from you, and also how the whole SUSS is handling this whole case challenge. Angeline, maybe over to you.
Yep. Hi everyone. I'm Angeline. So thank you SUSS for having me today to do the closing speech. I hope that all of you have had a meaningful and fruitful learning experience from all the past sessions. So in the first webinar, we learned that exploring the macro environment in light of globalization helps a firm determine how and where they should position it in itself in order to develop their strategic formulation and how they can unlock the potential of the macro environment through threats. So this includes the China's evergreen contingent fears and debates over US debt ceilings that have sent many indices to retreat within this month. So in the second webinar, we've learned how to achieve consistent profitability through reassessing weightings and balancing strategically. It's always useful to modify and do sensitivity testing based on different scenarios to really find out how your portfolios will perform should these scenarios happen. So in the third webinar, we learned about portfolio creation. As mentioned in the opening speech by Ethan, having a diversified portfolio helps a firm to minimize their risk, given that stocks can be a risky investment at any point of time. So more critically, we need to find optimal diversification and avoid under or selecting multi-manager products or mutual funds that cater to different needs. So I think we all know by now that ESG and impact investing is no doubt a framework to catch up on if you would like to stay up to speed with the market and finances. As at the heart of ESG investing is the simple idea that companies are more likely to succeed and deliver strong returns if they create value for all of their stakeholders. So this includes employees, customers, suppliers, and wider society, including the environment. So to end off, I would like to thank the iFAST team for all the time and effort they placed into arranging for professional speakers in the webinars, as our knowledge has definitely grown from the shared experiences. In alignment of SUSS vision, leading university for social good, and as proponents of ESG investing, we look forward to collaborating with like-minded industry partners. In addition, I would also like to thank Mr. Patrick's strong support for all of SUSS students in this case competition. As of now, I wish all the best of luck in the upcoming case competition, and thank you. Back to you, Mr. Bernard.
Hey, thank you, Angeline, for all this sharing.
Yeah,
Yes,
thank you.
Yeah, and as I mentioned, I think wow, in that short 1 to 2 minutes, we see the whole flood of attendees coming in, and I think we are breaking almost 60 plus people over in this webinar. Yeah, thank you. And today we have that mix of individuals who are here for the Quantitative Investing Festival, and also students from SUSS joining us as part of the case study challenge. And of course, I'm going to move into the topic that I'm going to share about. It's really about recurring income, and recurring income coming in just like how trust funds and endowments are actually handling them. I'm Bernard, and I think some of you guys may have met me, or including even talking over to me personally. Yeah, especially the students across from SUSS. My background is a lot into work on asset management, especially onto trust funds. And of course, I've been working with religious groups. I've been working across with different educational groups to handle their endowment funds as well. And when we actually handle all these funds, a lot of key questions that they always have across for me as an asset manager and a fund manager is really what investment model should they be using in order to be yielding some level of returns. So I have had countless of such discussion across with endowment funds, with trust funds, even individuals who are setting up a trust across for their family office, including even overseas clients coming to Singapore. I think in the last few years, we start to see an emerging number of overseas clients, especially from the Northern Asian area, from China, from the richer areas, the first tier cities coming over to Singapore to set up a trust over here. And of course, I had the privilege to handle some of them. And when we work across with many of such settlors, which means the people who start up the trust, they start to ask us as an investment manager, asset manager, what investment model we have. A lot of time when they ask these questions, it is everyone seems to have they just want one answer, as in they just want to hear that you are this investment model, you are only type A or type B or type C. On the contrary, every time I talk to them, I will tell them that it is not only just one single investment model, but rather we should be considering a multiple model, multiple asset positions, and be very nimble and adaptable in shifting across models, or even be very nimble to have multiple models available. So in this whole festival, in the last few days, I think we have mentioned a little bit about fundamental. We don't need to talk too much about fundamental analysis because that's always available. And I think we have spent a lot of our school days studying about fundamental, about macros, and that's really how fundamental comes in. Of course, I spent one short session across the SUSS students discussing about macros and fundamentals. And of course, in the majority, in the main part of this quant investing festival, it was a lot of discussion about quant strategies, which means a lot of technical analysis, setting up models, especially even looking at volatility, different variables, setting up models and benchmarks such that we have a computerized model that really sets where we are trading, what we are buying, and what we are selling. There are other models available, and I'm sure you will have heard about it, including even if you talk to the more senior investors, some of them say that, oh, I just want to buy and hold. Each of all these models that we see has its strengths, but each of the models that we see over here also has its flaws. And while we are discussing all these things, I want to bring a few models in, and these are models that you definitely will have heard about, or even you have heard or have seen many of such advertisements across in social media, on IG stories, even the more traditional Facebook, talking. People are selling such strategies and selling lessons to such strategies. I'm sure you have heard or you have seen some value investing schools telling you about Mr. Warren Buffett, about his style, or even the more senior Mr. Benjamin Graham about how value investing was started. So value investing by itself is a style, that's actually very strongly based across in fundamental analysis. Of course, over the last few years, especially from 1999 onwards, where we had the dot-com era, the dot-com era gave birth to something that we know was a growth strategy, looking at different cyclic investing and in which cycle, which are the growth stock that we are going into. Of course, past the 1999 dot-com era, in the last few years, the pre in 08, there was a pre-Lehman Brothers mini bonds period of time. That was a period of time whereby there was another growth spurt that went up. Economy was doing very well. Or even you have seen in the last 2 years, although the general economy was downwards due to COVID, the technological stocks, especially FANG, I think I mentioned a few times in some of the lectures, FANG, a few companies that we know, Apple, Amazon, Netflix, all these companies are really growing tremendously. And of course, we are also expecting that in China, the Hong Kong or the China tech companies would have another growth trajectory coming in over the next many years. So that's growth investing, which by itself is an investment model. So there are many models. And I guess the only point that I'm always trying to make is that we need not look at any model, but rather consider having all these models just like a color palette. So today, if I'm an artist, I'm trying to paint. I can't just paint with black and white. I can if I want to. That's called charcoal. So with charcoal or with pencil drawing, I can create a beautiful artwork. But if I'm only limited to black and white, there might be different terrains, different areas that I cannot explore into. Like I may not be able to show the vibrant colors of a blooming flower if I'm only limited to charcoal painting. And if I want to paint a wonderful picture of a vibrant color flower, I definitely need more colors available. And on my color palette, that's where I will need the green, yellow, red, bright blue, and other colors. And using such analogy, I want to bring back that as an asset manager or as a fund manager, or even today, if you are a retail investor investing your own money, all the more important, you should consider having different styles available, which is having different colors on the palette available for you to be painting. So today, I want to make sure that we have different models available. And the last 2 weeks plus, we have shared a lot about quant investing. And why do I want to focus so much in the last 2 weeks is because there might be an overemphasis about fundamental analysis over in the whole markets and even value investing. And what we want to do is just to balance these two out together. And today, I probably want to share one model which customers always like. And when I talk to trust funds, when I talk to endowment funds, they always like this, especially even the old uncle aunties that I work with. They always like to have a recurrent income or recurring income, whichever that we want to call it. And what actually is a recurring income model? This is actually really traditionalist in nature. Yeah, but I have changed that traditionalist part a little bit, adjusted it to fit the modern environments, and that will be able to tell us what is actually the recurring investment model. To put it simply, it's just like a business. So treat your portfolio, your investment portfolio, like a business. And in any business, there will always be a P&L statement, or when you're running accounts. And in any business, there will always be a revenue coming in. If your business has no revenue, then it's not a business. Then maybe it may be a charity. Nothing wrong across with it. Even charity have their KPIs and their measurables. But let's stick to businesses, because fundamentally, if you're running investments, we want an income, we want profitability coming back in. And a recurring income will just be like in a business where revenue will keep coming in. And it is very different from, like, example, let's say you are running a business, you have a one-off sale. That means you just sell a single product. Then your business would depend on your marketing and on how well you are selling all these one-off instruments. If I choose a business to buy into, I will want a business whereby their product has recurring sales and keep selling and selling. And one of the key advantage that we look at such recurring selling is that we will expect the income stream and the revenue stream to be very predictable. And if I want to have a higher income, very simple, it is scalable. I just sell more by targeting a bigger market, by moving in a larger area. So what am I talking about? So if I use a company as an example, some of the companies would be FMCG company. FMCG will be a fast-moving consumer goods. Yeah, so FMCG, I think those of you guys who have done marketing school in business school before, did a little marketing, you definitely know this term. Or even if you are working right now, you know what's FMCG. And very simply, a few FMCG groups that we all know about: P&G, Procter & Gamble, Unilever, yeah, down to the left. Example, Lipton tea is distributed by some of the very famous, I'm not going to share details, but people who are drinking tea will constantly be drinking tea. And if they are used to a certain brand and model, they will keep using that brand and model. Or maybe some of the very familiar brands over here that we have seen. When we talk about baked beans, maybe the first brand that comes to our mind is Heinz. Or if you are talking about, people talk about chocolate-based spreads, but we don't talk about chocolate-based spread. We just talk about Nutella. Yeah, it is already a term that's in our vocabulary. Or down to if you are talking about potato chips, yeah, maybe Pringles. Yeah, all these are big names that people are constantly consuming again and again. And that's what FMCG is. Yeah, fast-moving consumer goods. And what happens is that when there's an established consumption patterns, the degree of we can predict what's happening, the income is coming in, and there's a high degree of certainty that constantly happens in this whole business. So that's from the business point of view. And today, if you are running an investment portfolio, wouldn't you want to make sure that you actually have a constant revenue coming back in? It can be coming back in the form of dividends. It can be coming back in the forms of other things like coupons. So later, I'm going to share some of the models that can actually allow you to have a recurring investment income. And that's what I build across for some of my clients, especially on trust funds and endowment funds. And maybe even actually one of the first very simple idea that you have is that if all these FMCG companies are big enough and their shares are actually listed, the very simple direction will be actually buying into the stocks of such company. Maybe using case in point, very simply, everyone always talks about this. Traditional is a cliche example that how Mr. Warren Buffett, he drinks a lot of Coke and he buys into Coke, KO, the acronym is KO, Coke as a company into their stocks and shares. So it's as simple as that. If you see a Coke can keep selling, and of course, Coke has started selling not only just their drinks that they have, they started over the last 20 plus years, they have started selling their main competitor. Yeah, and their competitor maybe is actually not Pepsi. Their main competitor is actually water. Yeah, so people may drink water instead of drinking Coke. And of course, Coke as a company has started selling this brand name called Dasani over the past many years. Okay, yeah, so to come back, a recurring income can be as simply as buying into the company of the FMCG product that you see that is actually constantly going and constantly required. Yeah, so but I'm going to move in to share with you what are some of the strategies that trust funds and even endowment funds are using to get a recurring income. There are some models over here. The typical models, I'm not going to talk too much about it because those are models that you will be aware of. So I'm going to share 4 simple models which I use across for my more established clients. And after a while, they did realize that they are familiar with normally the first and the second model, but the third and fourth model is something very new to many of them. So let me share with you what I normally do. So when I actually start to onboard trust clients or even a certain endowment fund from, example, educational institutions, or even sometimes I handle endowment funds for religious groups as well. A lot of time, our first issue that we face with them is that they may not be taking enough risk, or rather, a lot of them are really way too conservative. Yeah, let me share with you two examples, 2 case studies that I've seen. The first case study is a typical MCST endowment fund. So what is MCST? MCST is the if you go to any condominiums, every single condominium has a committee that actually manages the whole condo. Yeah, and this committee, of course, is actually formed by majority, or if not all of them, should be the residents over there. Of course, in that committee, sometimes it also sits in the management office people. Yeah, so MCST always have an endowment fund. This endowment fund is used, is actually put in every month from all people who are staying there to save, to stand by for big repairs. Big repairs like today, if the lift needs to be repaired, or the lift has a lifetime, maybe the lifetime is only 10 years. If there's a need to change a lift, that's going to be very expensive. So over the years, over the months when management fees are collected, there's money that's poured into the endowment funds. Or maybe every 5 years, there's a repainting of the condo. That's going to be a huge jerk up in expenses required. So there's also an MCST endowment fund available. And many MCSTs that I work with, a lot of time, because firstly, the people managing the money are merely residents. It is, I would not expect them to have any financial knowledge, and which is normal, that a lot of time they manage only on a model of conservancy, of risk management, which means that if I'm given 3 million, I make sure my 3 million just grows based on how much money is required. And it's just don't lose money can already. Yeah, simply put, don't lose money, okay already. Yeah, lose money, people will blame me. Yeah, so that's what when I work with MCST, and a lot of time they are not taking any risk at all. And with interest rate being so low, many a times all this money are actually stuck in fixed deposits. And fixed deposits have a rate of probably right now in today's scenario 0.4, at most maybe only 0.5% interest. And that really does not justify their whole endowment fund at all. Although that committee or many committees did not allow the money to dip downwards based on the number over there, but the real fact is that the buying power of all this money has gone down. Because inflation, which is the price increase of goods and services, is increasing generally around 2 to 2.5% per year. And of course, with COVID, when market drops down a little bit, inflation actually goes upwards as well. And now that with the pending interest rate increase in the whole financial scene that's expected in next year and the year following, we expect inflation to be going up a little bit more as well. So with that, if the MCST only puts money into fixed deposits with no recurrent income model coming in, a lot of time the value of the endowment fund is actually decreasing by around 2% every year. And I would think that is actually not doing an MCST job already. Yeah, okay, so maybe not everyone may not agree across with this, but I really want to share this out in a very truthful point of view. And again, I have worked with religious groups as well, and many religious groups still relies a lot on fixed deposits, which only gives 0.5%. So there's something to think about. But how can we turn this situation around to make it into a recurrent income model across for them? So I give a few examples over here. Bonds are very traditionalist in instruments, but not many people use them because a tranche of bond will be approximately 200,000 to 250,000. Yeah, but I use a bond as an example. A bond is just very simply, you lend money over to a corporate or to a government. And the corporate or the government that you're lending money over to will return you a fixed interest. Yeah, in this situation, I just use a few bank bonds. So banks are pretty stable in nature. Of course, we know that bank as financial groups, they are very hard hit by the economy. Their stocks can go up and down. But in this situation, this is not a stock, this is a bond. So they have promised you to return you a certain interest, which is what a coupon is based on the bond that you pay out. Yeah, and of course, when the bond is being created, over here, this Credit Suisse, I think Credit Suisse will be a stable enough company that we're actually looking at, or stable enough bank that we are using. Same risk as any other banks that we have, giving interest rates of 5.6%, which I think is wonderful, 10 times more than what fixed deposit is giving. And of course, because the prices goes up and down a little bit, the actual yield is actually 4.3%, which is still wonderful. So with this, you can see that with very limited risk and with a very stable company available, just by not doing anything, just by buying a bond, the corporate, the company, whichever you're looking at, is already getting 4.3% per year. Of course, the investment return, is this high enough? No, it is really low. But compared to a fixed deposit of 0.4 to 0.5%, this is 10 times more than what is available. Okay, so this actually solves some very simple issues that I mentioned. I mentioned about MCST just now. I mentioned about some religious groups. And they are pretty comfortable to put money into the bond as long as they are aware of what they're actually doing. So over here, I think I've shared one of the first very simplistic model that we can be using. Let's talk about the next model. This second model is something that I see in a lot of, especially religious groups and charities. Some of them I actually see on the board across over with them. And that's actually just to spend the money to buy an investment property and leave the investment property over there to yield a rental returns. Okay, so I've seen this many times. This works sometimes in Singapore. Yeah, because Singapore has limited land space. And with limited land space, sometimes land is a scarcity. Yeah, so of course there's a process to how to buy. I'm not going to share. I think we all know about buying a property. Yeah, but a property also has its issue. So I will share a real case. I actually sit on the board of this religious groups. And actually, they have quite a few properties. From what I know, at least there are 2 properties that are actively being managed. There's a third and a fourth coming in as well. Yeah, many of them are actually donation to these religious groups. And one of the key issues they face when they are handling a property, is that property is very limited in cash flow. Yeah, what do I mean by limited? Which means that you can have at least $2 or $3 million parked in a property. If you want to sell this property, it will take you at least 6 months for you to sell it. Yeah, 6 months is already quite short. Yeah, because you need to list on the market, you need to reach a price that is agreeable, and the other party also needs a legal side to do things. So the transaction of property normally will take at least 2 months to 3 months, at least. Yeah, I've just shifted a house recently, and it took me actually 7 months to complete that whole transaction from initiation until end. And of course, today I'm happily sitting in my new property, but it took me 7 months. So imagine if it's a bigger size property, yeah, time is also a very big issue. And the other issue sometimes that we face is that if there's corporates that's actually holding an investment property, yeah, this is where one of the big problem is GST comes in place. Today, if it's me and you buying a property with each other, we are not corporates, we are individuals. We do not charge GST. Yeah, so the price example, let's keep it simply. I'm selling a property at $1 million to party B. It will just be transacted at $1 million. Of course, there are other fees that we need to pay, like buyer stamp duty, seller stamp duties. Those are duties, that's extra. But today, if I'm a big company and which I'm GST payable and GST chargeable, yeah, if I sell a 1 million property over to you, I need to charge you 70,000, which is 7% of GST out of that 1 million. So if I'm a corporate, or if I have an endowment fund, my group should be pretty big. Yeah. I sell a property at 1 million, I need to charge the buyer 7% GST, which is $70,000 at least for $1 million property, which means the selling price is elevated by 7%, which makes that property lesser, not as attractive as compared to other properties available. So all these are loopholes available. But of course, investment property, we all know that it can bring in a certain recurring income. And of course, it's a very highly leveraged instrument. We need not pay everything to buy investment property. We can pay probably around 25 to 30% and be able to own. Our ownership generally escalates towards 100% over the next many years. Okay, so don't need to talk too much. All this brings in income. So first two, the bonds and investment properties are very traditional instruments that are available to groups who want recurring incomes. Of course, the property can be leveraged in many ways and can be in different forms. What I've always been talking about, I think everyone will understand very well, will be commercial properties and even residential properties. Like example, buying a condo and renting a condo out. Yeah, so we have seen that. But there is also another form. There are many other forms of ownership of properties. One of the key parts of ownership can be through REITs, R-E-I-T-S. Okay, so I'm not going to share more. You can always Google a little bit about REITs. And of course, over here, I want to encourage you guys, when you have any questions on your mind, do put them in. Yeah, and I'm always starting to see some questions coming in. Yeah, so I saw that actually it's written over here. Do bonds only offer fixed interest? Are there bonds that offer compound interest? Okay, thanks for asking this question. Yeah, let me head backwards over to the bonds part. And I think I want to answer all these questions as they come in. And of course, I want to encourage all of you guys to start asking. Yeah, and I think that's where you can address some of the issues. Okay, bonds normally have a fixed interest, which is a coupon that's established at the point of starting this whole bond setup. So that normally is fixed for a period of time. Yeah, and not only fixed, sometimes they have this thing called NC period. NC means a no call period. Yeah, meaning, of course, today if I'm a borrower, as a company, I borrow money from investors, I may want to return that money as soon as I can. Yeah, but of course, I have a fixed period to say, this period of time, I confirm will not return one. Like example, sometimes you have this thing called NC5. It means the first 5 years that this bond is being created, the corporate will not call back on the bond. Or maybe it's an NC10. So those are features. But I think the question here was asking that, are there any bonds that offer compound interest? The bond itself normally do not compound. They will pay you cash outright for the coupons that's available. So if you want compounding, normally actually there's one set of bonds that will allow that to be done, is to use a unit trust, a fixed income unit trust, which has a collection of bonds, and there's actually a fund manager involved in that process. And there's actually a reinvestment tool available within unit trust. Of course, when I talk about unit trust, some people are cautious, saying that, wow, unit trust has a very high fees there. Bernard, are you sure you want to use unit trust? I think it is a subjective thing. Recently, from time to time, there is starting to have unit trust with very low fee or no trailer fee. Or even the other way around. Some people will say, hey, let's not use unit trust. Let's use something similar called ETF, exchange traded funds. Let's use fixed income exchange traded funds. My answer is recently there's also ETFs that charge management fee already. Okay. Yeah. So while I'm sharing about all these things, there are really great picks in unit trust that might be available, and there are actually really pitfalls. Okay. Wow. Okay. While I'm answering this, I think there's another question that came in. Really asking about what are the potential pitfalls of bonds to look out for when compared over to stocks. There are quite a few. Okay. And now that we talk about bonds, let me use a few names that are really very famous in the last few weeks. China Evergrande. You may have heard about it, but what exactly is it? You may not know. It's okay. Not much people know the details. I think the last few years, another name that was quite famous, iFAST. iFAST is a Singapore company that has defaulted on their bonds. So one of the key pitfalls that we want to look out for will really be about the credit situation of the company. So buying the bonds is very different from buying into stocks. Stocks will be looking at the overall business as a whole, the possibility of it earning more, the whole revenue line, looking at the sector that's actually in. So that's about stocks. So I'm not going to talk about stocks, but on the bonds point of view, we really want to look at the cash flow, which goes back to the accounting part of it. Because it's a very predictable instrument. Normally, every 6 months, a coupon needs to be paid out. We need to see, does the company have enough operating cash flow to pay out all these coupons? And normally, most of all these corporates that we that creates bonds, they are actually listed on stock exchange, and many of their books are actually opened across for analysis and for reading. So of course, we are able to do it a little bit more because in the region, I think we are one of the few companies with very established bond departments. Of course, that's why we call ourselves bond supermarkets. Okay, so just to address one of the common pitfall, the issue is about credit risk, which means that companies' cash flow, are they able to meet all these cash flow requirements? And if they're not able to, there's a credit situation coming up soon, then we want to be very cautious about those companies. And of course, we have brought up issues. I think China Evergrande, almost 3-4 months back, we already started discussing about whether would they default. They have already reached a default zone. Or even last few years, there are other companies that we have brought up, including the movie industry. So when COVID started, we foresaw that the movie industry was actually going downhill, and especially with streaming of shows online, the movie industry, the movie theaters are having another hard hit as well. So that will cause credit concerns. Okay, and of course, some of the things we cannot avoid. So when buying bonds, one of the key way is just merely to diversify. I think that's a very simple answer to a very complex issue. And really diversification, one of the ways, of course, if the trust fund or even yourself, your family fortunes, you have 10, 20, 30, 50 millions available, you can easily diversify. Because one bond is normally around 200,000 to 250,000. Of course, there are instruments available. Sometimes we cut a bond downwards. If the whole bond is 200,000, we cut them out into 40 pieces. It becomes 5,000 for each tranche of the bond. That will allow you to be able to diversify better. Okay, so a very simple answer to just now that question, how to reduce the risk of bonds. The key part is really just about diversification. Okay, a lot of Q&A over there. Let me just go back over to our main sharing, because there are still 2 more parts that I've not talked about, and that's the atypical models that we're actually looking at. Okay, so when we want to look into companies to be investing into, I want to raise up this possibility that has started in the last few years. The models that we see are familiar to many of us. I bring up models that you know very well. And this key model is to talk about software as a service. Remember just now I was talking about looking at companies Are there any company that has a recurring income that constantly comes back in? I use FMCG as an example, because if you are using a toothpaste and you constantly use this toothpaste model, you'll keep buying this toothpaste. So that's a recurring income model. Yeah, but things has evolved. And in the last few years, we have this thing called software as a service. Yeah, for some of you over here, if you remember enough, yeah, I don't know what's your age. Yeah, if you are as old as me, you're in your 40s, approaching 50, you will know that Microsoft Office used to be sold as it comes in diskettes or it comes in CDs or DVDs. That was many years back. Nowadays, you buy Microsoft Office, it doesn't come in a CD anymore. It doesn't come in a DVD. It doesn't even come in a hard disk anymore. Yeah, it's impossible. It comes with just a barcode with a product code for you to download that from online. In fact, things moving ahead. In fact, some you will see, maybe example, some computers do not even download the Microsoft Office. Of course, in the Microsoft Office 365 model, it is operating in the cloud. You just need an internet access in order to be using your traditional Word, PowerPoint, Excel spreadsheets. And that's what Microsoft has evolved their business model into. Instead of selling a single software to you, they are selling a subscription service, which means that you are liable to be paying every year when you use this service. It can be cheaper in nature, but it's a constantly refreshed, updated model. And it might even feel like a rental model, a crossover to you. But this is a wonderful model to the business. So to Microsoft itself, what they will have is that they're constantly collecting subscriptions. And if it's a subscription model, their revenue keeps coming in. So today, if you want to be investing your money into, look for companies that have subscriptions and a very sticky different subscription models coming in. So this is one very simple example to show a crossover to you. But I want to contrast this across to something else that you start to see in the industry. Instead of having a subscription model, the photocopiers that you see in a lot of offices right now are never owned by office. In fact, a lot of time it's a long-term or short-term lease. Lease meaning it's always a rental model. I'm not going to quote any model, but most photocopier, if not all photocopiers that I see nowadays, are all in a rental model. And I want to contrast this versus a Microsoft situation that we are seeing just now. And the main contrast is about stickiness. Yeah, stickiness meaning how are you going to, are you still going to carry on buying this service and carry on using it when the subscription ends? Yeah, and I want to use an example for photocopier because photocopier is actually, in my views, it's not a very sticky instrument and it's not a very sticky product because we can plug any USB or landline in, it will still work. Yeah, of course, I may need to change the driver in my computers, but a lot of time right now, even printing is over IP, printing over internet protocol. I may not even need to upgrade anything in my computer and I can use it. And this is a model, of course, initially, I think was started off by Xerox. Yeah, Xerox used to sell their photocopier, but over the years, they've been renting it outwards. And I think this has a small issue. It appears that this is just merely an installment rental model. Instead of, today, if you grow up using Words, most of your Word documents will be your document behind your extension is DOC or DOCX. You're so used to the Word formats. Of course, recently over the years, there's OpenOffice, that came in. Those of you guys who are in national service may have at some point in time used OpenOffice before. Yeah, of course, in the last few years, I think Google has their own Office software as well. But there's a strong stickiness over here. If you're a Microsoft guy, if you're a Windows guy, you will keep using Windows. Just like for myself, I'm not a Windows guy. I'm an Apple guy. Yeah, so I will always be using Mac computers. And that means that there's a strong stickiness over here compared to a photocopier. Ultimately, what's precious is not about the photocopier. It's about the document that I'm going to photocopy or the soft copy things that I'm going to print out. As long as it prints out correctly, in a very clear format, that's good enough across for me. So I want to emphasize this part. If you're investing into companies there's a subscription model, look out for the stickiness. If that company is not sticky in nature, then I think we really don't even want to be investing across over to it. So this is one key part that we look at. And of course, if you are consulting for any company or even for yourself today, if you're looking out for companies to be buying into or even creating a recurring income model for yourself, for your family, I think look out for this part, and I think it's really, really important. Yeah, what are other software as a service platforms that we are starting to look at into? I think another model similar over to Microsoft is Adobe. So they have their Photoshop series, they have Premiere as video editing series, and all those are wonderful software platforms that I start to see many groups are actually using. Okay, so this is the third model that I'm actually looking at, and a lot of time I put some of my clients' trust funds, endowment funds into companies which has a subscription series. Yeah, okay, I'm going to go into the last model to share more crossover with you, and of course I want to welcome any questions that comes in as well. Next few one that I want to share is that recently I've been talking to funds, to trust funds, to endowment funds. They start to tell me that, hey Bernard, by following the very traditional model, yeah, the return is not very high. The return is only probably around 4%, and they do understand that it's actually eroding into their funds. So a lot of time, I actually get them to move backwards as well, and that's where in the last few weeks you have heard about different models available, and sometimes I will get them to park a certain portion of their funds, can be 10%, 20%, into something that they think that has growth. They may not have a lot of knowledge into it, but there's trusted fund managers to be running it. So there are some of the models, like including even I think we mentioned about quantitative investing. That's a very simple model to be using. The MCST, something that I work with, they don't understand everything, but they know that they can afford to put that 5% inside. 5% inside that grows maybe 10, 11, 12% per year. And that's something that I think they are very comfortable with placing. Or sometimes we put them to get into our discretionary portfolio management service, DPMS, so that we can actually grow their funds. And what I'm trying to tell you over here is that at times, even very traditionalists, I've worked with some families who are probably in their third generation or fourth generational wealth. Yeah, so they have gone through their grandparents, their parents, and themselves right now, the third generation wealth. They know that they are able to put some money into hedge funds, into quant investing, into even portfolio management services to help them to get some growth. And this is something that is very new, but people are starting, especially third generation and fourth generation wealth, are starting to be very open into. And I want to encourage that this will be one of the models that you guys should be thinking about, especially if you are managing funds, or even if you yourself are looking at models. So let me backtrack a bit. If you notice, I'm actually constantly coming back over to here, that we want multiple models available, not just one, but more than one available, such that the whole portfolio becomes nimble, becomes adaptable, and we are able to switch it around during different market cycles, because markets can be going up and down. Of course, the up is normally a lot more, the down period can be a little bit shorter, but we want an all-weather strategy, or even a multi-asset strategy available. Yeah, so what I'm always encouraging is that treat ourselves as an artist, that we have different tools and instruments available for us to be playing around with. Yeah, okay, I think I shared a lot about possibilities, about how trust funds constantly are getting recurring income. I want to put into perspective some issues. This sounds sexy, right? Or even spicy, or interesting, that if I can have constantly recurring income coming back in. But I must tell all of us over here, especially if you are an emerging investor, or a very young investor, you may not have a lot of capital available. Yeah, recurring investing model is not for everyone. I will show you why. Let me put numbers into play over here. Yeah, I don't know whether I have calculated it correctly. Okay, I have one less zero over here. Yeah, now that I think about it, in a recurring model situation, yeah, normally the income that comes back is probably around 2 to 6% per year. In fact, I normally don't see 6% one, unless their black box part is actually quite big. Yeah. So what I want to share is that if the average return is around 4%, if they get 4%, it's quite good already. And 4% must minus away management fee for all the asset managers. So this is wrong, but if there's a 10 million investment at 4%, it's approximately 400,000. Yeah, not 40,000, it's 400,000. Yeah, it's only 400,000. And of course, if you are an emerging investor or a retail investor yourself, where got 10 million available? Yeah, 10 million means that most probably you are probably the third generational wealth already. Yeah, even second generation wealth that I work with normally don't have 10 million of investable cash. Yeah, a lot of them are actually locked across in properties. Yeah, so I want to bring across one key point over here. And that key point would be the return are not very high one. It's around 4%. And with this 4%, unless your pot of gold is very big, if you have a very big pot of gold, that 4% becomes something that's substantial that can be used meaningfully. If you don't even have a pot of gold, if your pot is really small, and it's not even filled up yet, and it's just partially filled, you must know 4% of this very partially filled small pot may come up to be really minuscule. Okay, yeah, I'm not addressing any point over here, but this is just pure math. Yeah, so with that in point, I have clients came over to me and say, hey, but I just want a dividend paying model. Yes, we can do that, but we must make sure that our expectation comes downwards as well to make sure that we are able to get a return that what we are interested in. If not, you might be very disappointed every year when you see that some of your returns are not coming correctly. Yeah, so over here, I also want to share some risks and concerns that we always see. Is that over the last many years, I start to see there are fund managers selling this called MIP, monthly income plan. Yeah, which every month you have a certain income coming back over to you. And this income sometimes when I calculate it backwards seems to be quite high, way beyond the 4% that I normally see in a real portfolio, or even beyond 6%. And sometimes when we do question, what is this monthly income plan? And what we realize is that, let's say, remember, we have a pot of gold available, and then there's dividends or coupon that comes out. We realize that the monthly income plan does not tap into all this dividend only. They even tap into the whole pot of gold, which means over the many years when they keep paying off this monthly income plan, the pot just gets lesser and lesser. Sometimes it grows a little bit when the market goes up, but a lot of time it's constantly eating into the pot and just gets lesser and lesser. That is a very concern that I have there. Yeah, it is not a recurrent model that is yielded from dividends or from coupons or even capital appreciation. It's the income is actually yielded from the capital itself. So imagine today, I say, hey, let's go out for a feast, but we are not eating just the food that's on the table. We are even eating into our own skin and flesh. Sorry, that sounds a bit morbid, but if we eat our own body in order to feast on things, I don't think that's a very correct model. Yeah, so to put that into place, even a recurring income model, there are different parts of it. There are some asset managers who will eat into the capital, which sometimes I think may not be the main intention of the trust holders or the trustees. Okay, yeah, so of course I've shared a lot so much, and I start to see other questions coming in. Again, another question regarding bonds. Let me have a quick look at what this question is. Yeah. Okay, so it was mentioned here, how come for Evergrande, for High Flux, etc., they can let their debts be so much without raising any warning or red flags? And that's a question from Mark. Yeah, thank you, Mark, for asking this. And let me address that across over to you. There are different industries available. And so I think the main question over here is about leveraging. What is the correct level of leverage that companies should have? Yeah, a lot of time it's an over-leveraged situation. Yeah, and I think I will simplify the answer across over to you. In China Evergrande situation, it was an over-leveraged situation. Yeah, if you look backwards on our Lehman Brothers mini bonds, of course, the mini bonds are not bonds, but it was also an over-leveraged situation on the basis of high valuation. Yeah, what does this mean? Yeah, let's say any property company, let's say I have 10 plots of land. This 10 plot of land used to be I bought it at $10 million. Simple answers are 10 plot of land at $10 million. But over the years, this 10 plot of land has grown, perceived to be grown to $20 million, which means it's twice the sum. I can always borrow 50% of the value. When it was 10 million, I can borrow 5 million. But suddenly when it has grown to 20 million, I can still borrow 50%, and it's become suddenly grown to 10 million. I can actually borrow more, and more people are willing to lend. And I think that's where the main issue is. Yeah, if I'm borrowing from a bank or a financial institution, a lot of time all this financial institution may come back to assess the asset that I have. But if I'm borrowing through a bond, an open issue of a bond, a lot of time retail investors may not scrutinize the actual financial accounts of the company. The only thing that they will scrutinize in fact, they don't even scrutinize, is actually on marketing prospectus and how well known the company is. If the company is very well known, then people tend to have a higher faith and higher trust. If the company is not as well known, then okay, maybe I don't want to buy into it. So you notice those companies that has actually gotten that has defaulted on the bonds can be over leveraged. That's the first situation. But in the second situation, they tend to be very big names. Yeah, again, no, not inclined to any of the companies that's mentioned over here, but they are big names that easy to sell. Yeah, maybe the only name that I'm going to quote is a name that has fallen already: Lehman Brothers mini bonds. Yeah, again, they are not a bonds, but as a product, Lehman Brothers was very easy to sell, very popular name. Yeah, but has anyone scrutinized in the product, the whole mini bond structure, the whole collateralized debt system? Not much people has. Again, it's not easy as well, because I remember 10 years back when I entered into the financial industry, the mini bonds was offered to me to be using as an instrument for my clients. I rejected the use of it, not because I know what it is, and the fact that I rejected is because I don't know what it is. So I told the few banks that was coming over to market to me that I don't know how to share this with my client because I don't know how to use it. It is not a bond. Yeah, it is a structured instrument. And that time I also don't know what's a collateralized debt. Yeah, so to put it together, just to answer Mark's question again, the key issue that's being raised are two. The first part is actually over collateralized. Yeah, that means the leverage is over leveraged. The other part is that actually a lot of lay investors or investors are only buying on the basis of marketing information and not based on really scrutinizing their credit situation or their overall books. Okay. Of course, I know that some of you guys might be interested, of course, in bonds purchases and bond information. Glad to tell you, just go on over to our website on Bond Supermarts. All these are free information available. A lot of our analysts, we sit together with them to discuss some matters, and we publish papers based on that. So that will be information available across to many of us. So of course, yes, I'm going to come to the end of this session over here. But I'm not going to end without something that we've always been doing in our Quant Investing Festival, and that's really to go into our quiz, our last few quiz that we are going to have. Okay, and if you have sat through our Quant Investing Festival over the last 2 to 3 weeks, you will know that we are constantly having this quiz segment, and I'm sure many of you guys have answered it correctly. And you have accumulated many scores. Yeah, I'm going to start sharing this part over here. Yeah, and we are still using AHA slides. Yeah, so if you have your phone across with you on hands, regardless of which group you are you from the quant investing part, or are you actually from the student from SUSS? Maybe just take out your mobile phone over with you, scan this QR code on the left, or if you're onto a web page, you can just key in ahaslides.com /M3Y2W, and you'll be able to get into the page. And thank you for all the wonderful emoticons that we are seeing over here. Yeah, I think most of you guys might be in. Okay, I see there are quite a few guys, but only 28 are actually into the page. I'm just going to give you a little bit more time just to scan on the QR codes. Yeah, later you'll be asked to key in some information, and I will assure you all this information are merely for this quiz and competitions. And regardless of which group you are from, just to let you know, the top few prizes will be some vouchers across from our sponsoring group. And also the most wonderful part is that there will be a course package across from all quants for the top few winners. Yeah, wonderful. So for those guys who have scanned the QR code, please get in right now. Thank you for all the emoticons, the love and the hearts. Yeah, and let me just head straight into the quiz right now. So if you have missed the part just now, it's still okay because the URL is still on top, a crossover for you. We're going to start the quiz right now. Okay, let's get in, and I see all the names coming in. Thank you. Yeah. So okay, yeah. So some of the questions in, just to bear in mind, yeah, we There's no need for you to reveal information that's too much. Yeah. So okay, this is the first question. Which of the following is an encouraged investment model? There are a few models that I mentioned just now. Yeah, we have 1 minute for all of you guys to answer your questions. Just click it across over to your phone, and you might be able to enter into the page. Yeah. Which of the following are the possible models that you can be using? I mentioned there's many models you can use. Do you want to be punting your money, just going in just like a casino? Maybe growth investing is actually one of the way, or it can be a trial and error. Try CC, which one is good, which one is not. Of course, that you can follow opinions of all your friends. If your friends have some opinions around, and they will tell you, hey, buy this, sell this. Yeah, okay, so there's 4 choices available. Yeah, thank you for all the encouragement from everyone. And just the last 10 seconds coming in. We will be revealing the results right soon. Yes, time's up. And of course, the correct answer is growth investing. Well, I still see someone choosing trial and error and punting. That may not be the direction that we are looking out for. But of course, thank you for the for those of you guys who answered it correctly. Let's look at the next questions. Okay, the second question. We have 1 minute to be looking at it. It's coming right now. So we mentioned about software as a service. Yeah, so what will cause subscription services to fail? That means they will not do well. So there are many subscription services available. I shared about a few examples. Like example from Microsoft. I shared about Adobe as a software. I also shared about Photocopier as an example. What are some of the fatal mistakes that we are starting to see? Yeah, maybe as a subscription service, the interest rate that they charge is a little bit too low, or maybe the environmental interest rate is a little bit too low, or maybe their subscription service, they want to do some goods and they'll be being very philanthropic in nature, and that may cause them to fail. Or maybe there's an absence of stickiness in the instrument and the products. Or maybe it might be an emerging company that has too much capital available and they may be failing. So make a choice. Which one do you think is actually the correct answer? And just the last 10 seconds for everyone. Okay, we'll be revealing the answer right now. And you're right. The answer will be the absence of stickiness. Okay, so that's all for the 2 questions that we have. Thank you for joining us today. Yeah, and our wonderful partners across from SUSS and even from All Quants, our educational consultants who has been working with us tirelessly for the last 3 weeks. And for those of you guys who have seen iFAST in the last few years, you will know that our CSR, our corporate social responsibility, includes a very key part to inculcate financial literacy across the public. And of course, today our main focus is to focus on financial literacy for the lay investors like you, and also including the students from SUSS. So thank you guys for joining us today. Yeah, and we will be back across I think Saturday. We have 1 more sessions that will be coming in with some students sharing. Yeah, so thank you for joining us, and we would love to see you again. Yeah, for those of you guys who want to be linked up across with us more, drop us an email and we will be able to be catching across with you. Thank you, and we'll see you again. Bye-bye.